ready to take your investment game to the next level? Introducing Digital Investor, your ultimate guide to mastering the digital marketplace. Whether you're a seasoned pro or just starting out, Digital Investor brings you cutting-edge game theoretical strategies, expert insights, and real-time tips and tactics to analyze, evaluate, invest, and grow your wealth. Don't miss out on the digital revolution. Visit www.nickblacknex.com and start your journey with Digital Investor today.
I read a pretty interesting statistic yesterday. Do you guys know? Let's see some guesses. Do you know how many people got liquidated since Saturday? Between Saturday and yesterday when I went to bed. So we'll say Monday night. So Saturday night. It wasn't even all full Saturday, but Saturday night, Sunday night, Monday night. 3 days. Do you want to know how many jackasses got liquidated? Like positions gone, poof, see you later, bye. 37. Unless you read this specific article, none of you are even going to be close. You're going to be off. I bet you're going to be off by more than your entire portfolio. Let's see what you can come up with. Somebody get one close. 20 minutes. Joseph, come on, you're smoking crack. It was 751,000 yesterday. 751,000 people. The money is a lot higher. The money's probably going to come in well over 10 billion. But it was screen is hold on. Let me de-smudge that screen. 751,000 people. Joseph, you don't have 199 million in your portfolio. Stop it. Okay, now you guys are just acting dumb. All right, $10 billion, but not. Did you guys hear the question? I think Audrey was the only person that heard the question. I figured out why you guys aren't rich yet. $751,000 people. 750. Think about that for a second. What city do you live in? Most of you live in a city where that's not a significant portion, but 751,000 dumb asses with leverage. Poof. And it's gone. Doesn't that sound crazy? Maybe not. Maybe I'm the only one that sounds crazy. Anyway, the best part of this article wasn't that 751,000 people got irradiated, that they got wrecked. The best part is it said, and these are all technical analysis people. These are the same jackasses that you see making these wild predictions. Well, actually, sorry. It's not the people you see on Twitter making predictions because they don't actually invest. They just have Twitters that make predictions. The dudes that you see on Twitter saying, oh, this is likely to, Benjamin Cohen and all these guys, they own nothing. Nothing. They have zero exposure. None. There's one dude that I know of that I think went all into Ethereum. He actually invests. It's nickels, but he actually invests. Every other one of those dudes, I think Vanderpope or whatever his name is, he actually invests money. All these other guys are just jackasses that give everybody bad advice based on squiggly lines. But this is the best part. It's said that after these kinds of liquidations, these technical analysis traders, they're not going to rush back into the market. They're going to wait for macro data. I wonder if maybe they should have started with macro data. Isn't it funny that when technical analysis that doesn't work breaks down, which it always does, and those guys get nuked, which they always do, then they clutch their pearls, fake pearls, obviously, and they sit back and they say, we're going to wait for the macro picture. You can't help people, man. You can't help people. So there is that. Perspective and perception. Those are two distinct differences. Okay. So, yeah, a lot of people got nuked. My advice kind of was just wait and see. Like, let these things play out. These things usually, these cascading liquidations happen over a period of days. And they kind of mount up. And you don't want to kind of jump right back in and try to beat someone when there's the liquidations happen, and then there's those secondary liquidations, and then there's those people that were at the fringe, and then there's people that just panic out, and it was other panicking people from the very beginning. But I think we lost a lot of the new investors, a lot of the people that were just here since mid-November. I think a lot of them went away, but not all of them. And the proof is that a lot of the dummy coins are still doing quite well. Say the dummy coins, like, you know, your XRPs and stuff like that, the kind of coins that people buy when they don't know anything. I hear that a lot. I try not to be mean about it, but when I hear it in public, they're like, "Oh yeah, I'm into crypto, XRP." I'm like, "You're not into anything, buddy. You're not into crypto. You're into Twitter. You got sold a bag of goods like everyone else." Anyway, so a lot of the sentiment dummy coins, Cardano is another one, a sentiment dummy coin. Cosmos, it's frustrating with Cosmos because it's actually a really good project. But another sentiment dummy coin is Algorand. And there's just a handful of these sentimental dummy coins where people in the past had heard about them. Now that the price is lower, it makes more sense to go buy it. But it doesn't make any sense to go buy it because they're not basing that off of any fundamental understanding of the markets. They're just, "Oh, I remember that one. That one's familiar to me. I should buy it because the big reset or something." So there's a lot of really flawed math, and a lot of people are basically investing in stuff that they've just heard of, and they have no clue at all what it means. And so we are going to go back over the 5 T's again today because I think that's important. And I think that we've been skipping that a little bit. So we'll probably do a little bit of 5 T'ing. So let's shift gears a little bit. Let's go look at markets. I think you could start dollar costing your way into what you think is quality. Let me see. What are the opportunities for staking, lending on tokens? Philip, that is a rich question, buddy. There's tons of them. Depending on where you live, Kraken just opened up staking back. They just opened it back up now that Gary Gensler, punchy head Gary Gensler's gone. Can you believe MIT accepted that jackwagon back? What an embarrassment. I used to think MIT was something. Now, I think it's something else. Oh, side note. Well, not a side note. This is a reminder. Okay, on your question, Philip, there's lots of staking and lending opportunities. You just got to decide if it makes sense. When you guys are thinking about staking, make sure you understand, can you be slashed? Meaning if the validator you're staking with screws up, can they take your money? There are scenarios where you can be slashed. Even Ethereum validators can get slashed. So understand if they're slashing or not. Okay. Next, understand what the exit scenario looks like. Understand if there's a thaw period, a defrost, thaw. They usually call it a thaw period, or a holding period, or a waiting period, or a whatever. For instance, with Jupiter, you stake Jup, J-U-P. If you want to get your tokens back out, you unstake. It's 30 days. And over that 30 days, your voting power diminishes in their DAO, their decentralized autonomous organization, which, by the way, is just about the only good DAO that's ever actually existed. All the rest of them are pretty much bullcrap. But you have a 30-day cooldown period. That's the longest I've seen. And they have differing ones. I think even my Ethereum on Coinbase, it's like 12 to 13 days. But I get like, what do I get? Like one Ethereum a week, maybe? I don't know. I have to see. But anyway, even Coinbase for some clients is stopping staking, like on Ethereum. Matter of fact, I think it's weird. It's like if you're in California, for whatever reason, if you're in California, a lot of them are a lot of the companies, even Kraken, they're discontinuing staking. So pay attention to where you live, then look around and see, okay, do you trust going out on the risk curve a little bit and using a partner like Bitrue, B-I-T-R-U-E? I love their exchange. It's like a mini Binance. It's not super liquid, but it's not like Gate. Although Gate seems to be getting better. Gate.io, but you're going to need a VPN for that. And I wouldn't be staking anything over there, although they have a lot of really cool. Gate has a lot of cool stuff, but that's a Chinese company. So just, be careful. Yeah. So that's what I would say. Yes, Andy, it is paying, but they're discontinuing it for a lot of people in depending on the jurisdiction you live in. I got an email saying that it would no longer compound. Like I had it with compounding, where it would take my new Ethereum and post it in the thing, and it would keep spinning it. And now it's not; it's spitting it out. So now my Ethereum is no longer auto staked. And it said that I think sometime in March, either the beginning or the middle of March, they're just going to discontinue staking altogether, which is fine. I don't mind. It's 2.5% on Ethereum doesn't mean anything when, you could just be selling options against it and all that. And again, I'm still waiting for one of these idiot companies here in the US to offer legitimate options trading against Bitcoin and Ethereum, because that is a constant moneymaker. You can make a whole revenue, like a really nice revenue stream, a really nice income from selling covered calls and cash secured puts all day, every day. You can make money on your money and you can make money on your crypto all effing day. See, I said, you heard the F. You thought I was going somewhere, but I didn't. I reeled it back in. I'm good in the beginning of the week with my profanity. What happens is I push towards the end of the week, the more like people like Tesla employees and stuff that I ever have to deal with, the more I go towards the vulgar. I deteriorate. My vernacular deteriorates. This one is pecan pie. Pecan pie. Yeah. For the digital private client stuff, a big part of that is going to be option selling. I did notice that CBOE, I think they launched a kind of weekly futures thing, but the problem is there's no premium in that stuff. There's no good premium to be had. And you're just incurring tax issues. So We want to be full options. Remember, there's all sorts of derivatives. There's forwards, fast, futures, swaps, options. Options of the derivative we want to be in, not futures, not swaps, default swaps, things like that. No. I can't, Barry. My rants are too much. People can't accept the rant. I had to dial my rants down. I have to have you notice I haven't really had some good rants. Oh, I think I did have a good one last week with Brad Garlinghouse because he's such a creep. But that's like one of my triggers. Anything Brad Garlinghouse does. Yeah, anyway, that's all right. The rest of the whole world community just ripped him to shreds. So yeah. Yes. Oh yeah. That was a good one. And that was the Be the Casino. And selling options, for those of you that don't know, does everybody here kind of understand how that works? Give me a show of hands, yes or no. If not, I'll cover that really quickly because that's probably important. If you understand what I'm talking about when I'm saying covered calls and cash secured puts, say yes. If you don't understand, say no, understand. No, understand. Do you know, Andy, you know plenty. All right, I got more than a couple no's. We're going to cover it real quick. Okay. I want you to think of it like this. Let's reduce this to the absolutely simple. Matter of fact, let me just see real quick. Options. Let me see if I have any of that artwork still. Options, contract templates. Go on. Yeah. Okay, I think I can pull this up. Give me a second. Let me see if I can do this right. Let me see if I can pull this up because in the context of this discussion, this would make sense. Oh, let's see. Window, here. Oh, yeah. You guys see that? You see it. Oh, you see it. All right. Let me get it bigly. Didn't get big. Well, it's the same, but it's the same but better. Okay. Let me may even be able to make that a skosh bigger. Let me see. Oh, snap. Look at us. We're doing big things. Ish. Okay, so let me do this for the sake of super simple. Yes, Lisa, I get it. Super simple is super good. Okay. In your mind, let's pretend just for a second that Bitcoin is $10,000. We're just going to try to keep this simple in your mind. 10,000 is an easy number. You can just add a zero. We could add a zero to all of this. Matter of fact, we probably could add a zero to all this. Well, you can see when I did it. I did this early in 2021. So this was something that we really focused on a lot. And there is a lot of money to be made, but it's a slow grind. However, it's a slow, continual, very consistent grind. So here we're talking just about Bitcoin. This is covered calls. And I think I even have banners if I didn't nuke them. Let me see. Because I remember we used to do this every other Saturday. We used to go over covered calls and cash secured put. Oh, snap. Call options. These are contracts that give the option purchaser or buyer the right, but not the obligation to buy an asset at a specific price. Okay, that's a call option. You guys get that. You can buy options on all sorts of things. Those of you that own IBIT, those of you that own any of the Bitcoin ETFs, there may be some of you. I don't know who here owns those. But if you do, you can do this right now. Like this second, right now, this second. If you I don't know if they let you do cash secured puts. They may, but I know that they will let you do covered calls. So anyway, a call option. It grants the buyer of the option the right, but not the obligation. You're not forced to. It's not like a futures. It's not like when you buy an oil contract and now you have to deliver it somewhere. That's not what this is. So this is a call option. You don't want to be a call option seller. Why? Do you know how many options expire worthless, percentage-wise? Let's see a guess. And yes, you should be able to do this, Donna. You should be able to do this with ETH as well. And I know all of that's coming this year anyway, even if it's not immediately possible. You sell puts on IBIT. Okay, cool. So you're doing cash secure. Okay, so you can do both of these. That's great. That's right. 90%. And yeah, sometimes it's high, depending on market situation. But the aggregate is that 90% of options expire worthless. Think about that. So the way I describe it is, if you have there's a road out by your house, right? Your driveway leads to a street and you have to cross the street. If 9 out of 10 times when people cross the street, they get hit by trucks, would you cross the street? Would that be somewhere that you would cross the street? I would say no. That is a bad bet. So you don't want to be an options buyer. That is the most degen of the options plays. You want to be a seller. Don't be the gambler going in the casino. Be the casino selling all of these suckers a chance to guess it right. All right? So with that in mind, we understand what a call option is. Now, that's right. Be the casino, baby. Be the casino. Now, let's take it a step further. What is the difference between a covered and uncovered? Well, a covered call is what you sell when you own the underlying asset. Does that make sense? So, and this is a financial transaction. This is a covered call. And this is what you would do if you own Bitcoin or if you own any of the ETFs that have options chains. I know that IBIT has options chains. I don't know if they have it on Ethereum, but I know that they have it on Bitcoin. And there's probably several others. So anyway, it's a financial transaction in which the investor selling the call options owns an equivalent amount of the underlying asset. So you're not selling naked, sailor. And this is how I originally thought that Michael Saylor must be making money. I thought, well, there's because he kept talking about this Bitcoin premium. What the hell is a Bitcoin premium? That doesn't make any damn sense. It's some voodoo math bullcrap that he put together that he entices investors with, that he's completely made up, and it doesn't exist. It's a fake term. But you can derive yield off of your Bitcoin. The way you do it is by selling covered calls. Okay, so this is what a covered call is. Let me quickly talk about the other side of the equation, which is the puts. So imagine in your account, again, for the sake of ease, imagine in your account you have, matter of fact, why don't I make I could make it. Anyway, you have one Bitcoin, and we're thinking Bitcoin with $10,000 of Bitcoin, right? Let's just go back to $10,000 math. One Bitcoin is 10K, and you have $10,000 in your account. Okay, so equal. I generally proceed that way, but this is for the example. You can also sell cash secured puts against the cash, and depending on where the price falls, lower or higher than your put contract, you could get put into the asset. That's what you're getting put into it. So a put option, these are contracts that give the option buyer the right, but not the obligation, to sell or sell short a specific amount of an asset at a pre-specified price. I'll probably pull up some options chains on here in a second so that this will make more sense. But again, you got to kind of make sure you got these parts correct in your mind. You want to understand what a call option is, what a put option is, what a covered call option is, and what a cash secured put is. So when you're buying put options, a lot of times they're purchased as insurance. So with a call option, when you look at the options chains, you have the price of the asset, $10,000. As the price goes up above 10,000, those call options contracts are worth more and more and more, right? And the closer to the money they are, they trade dollar for dollar. And then what happens is the amount of time that's left, there's a certain amount of premium in that time. Premium is the amount above the cost of the underlying asset. Let me not get too confusing. Let's stick to where we are. So we have put options. Okay. These allow you, the buyer of a put, the right but not the obligation to sell or sell short a specific amount of an asset at a pre-specified price. And what happens is with cash secured puts is you're essentially using your cash to sell against that cash. And if you get it wrong, they swap your cash for Bitcoin in this case at that price. So a cash secured put involves writing an at the money or out of the money put option and simultaneously setting aside enough cash that if the price goes down, they're going to push you into that asset at a specified price. So $9,000, you sell the $9,000 puts and you collect some premium, $100, whatever. You get that $100, but they're going to lock up that $9,000. Why? Because if the price goes below 9,000, you're getting filled at 9,000. If it goes to 1,000, you're getting filled at 9,000. That's the cash secured part. You're putting up cash, and the put option that you sell, that's the price where if the price of the asset at expiration is below that, you're getting put into the asset at that premium, at the price that you paid, the strike price, where you sold the option. So if you sold the 9,000, you're going to pay $9,000 for a Bitcoin. Does that make sense? Okay. So let's make sure that we've got this part. Is any part of this murky yet? Let's see, BTC and GBTC. I don't know where BTC has options. Tim, I think you might be reading that wrong. There was a platform that had cash. Remember, spot. This is spot markets, not. And they do have options chains on GBTC, but remember, GBTC is a trust. It's been converted to an ETF. On E-Trade, yeah, but Tim, you can't hold Bitcoin on E-Trade. So I think you're talking about one of the ETFs. You can't, like E-Trade, at least where I'm at, because I've had an E-Trade account forever. You can't warehouse Bitcoin. You can't custody Bitcoin. There's no Web3 wallet there. Yes. No. It's backwards, Joseph. You want to call your way out and put your way in. You want to put your way in, meaning if I'm going to buy something, I want to buy it with puts. Mini BTC, I don't think you can custody Bitcoin there, Tim. But I think you're looking at something else. You may be looking at some kind of proxy thing. You can't take Bitcoin and send it to E-Trade and then sell options against your Bitcoin held on a Web3 wallet somewhere at E-Trade. That's what I'm saying. There may be, I think you're looking at options, either cash settled options against a pile of cash, which is still cool, but it's a little weird. Oh, yeah. It's that's what I'm talking about. Oh, the ETF. Yes, they have ETFs. That's not what we're talking about here. Yes, you can do this against ETFs. The theory is the same, but there's always going to be some weirdness because ETFs don't track dollar for dollar Bitcoin. What you really want, the cleanest, most elegant process is you want to sell directly against your Bitcoin or directly against your Ethereum, not a proxy asset, because that's the second derivative. You have the futures price is what those are based off of. And then the ETFs track the futures. Why is IBIT different then? IBIT is an ETF also. They're all a little bit different. It depends on how they structure their ETFs. And we could have a greater discussion maybe with Brandon about how the ETFs are structured, but all of those ETFs are structured a little bit different. It's not dollar for dollar, because go find me one ETF share that costs $99,700. No. And yes, I mentioned IBIT because you can do this with ETFs, but that's not what I'm talking about here. You can use this same process with ETFs, but this is not about ETFs right now. We're talking about the actual asset, right? Because in this case, you would have to go buy a bunch of IBIT and then do this. So how would you buy it? You probably sell puts, collect some revenue, and get put into IBIT. And then you could do it with IBIT. Just remember, it's not directly correlated. IBIT doesn't move exactly with the price of Bitcoin. IBIT is traded, right? So there's the trading of IBIT and the connection between IBIT and the price of Bitcoin that is kind of reconciled by BlackRock when they do those purchases and sales. It's not directly, it's correlated, but it's not dollar for dollar connected. Does that make sense? So there's always going to be a little sloppiness. Again, I think we're talking about the same thing. I think we've covered that. Okay, so a cash secured put, you're writing an at the money or out of the money put option and simultaneously setting enough cash to buy the Bitcoin. Does that make sense? Yes, and they are very liquid. But again, and this is the final thing I'll say on this, if you're doing this with the ETFs, you're doing it through an exchange, through an ETF that roughly correlates to the price of Bitcoin. But remember, Bitcoin is traded by people and the ETFs are traded by people. And it's not the same people, and it's not even the same asset. You're buying or selling a share of a thing that relates to a company that purchases or sells Bitcoin that's traded by Bitcoin traders. That is not the same thing as selling options against the actual underlying asset of Bitcoin. It's just a little bit different. You're once removed, so there's sloppiness there. Just be mindful of that. Okay, so let's go back to our example. We have a $10,000 Bitcoin. Okay, let me get my banner off there. We have a $10,000 Bitcoin. And in this case, these are mini contracts. So there's 100 mini contracts equal 1 Bitcoin. Does that make sense? So 100, like $10,000 broken into 100 is $100, right? So each mini contracts. Okay, that's how it worked over at Ledger X. That's basically how it works at Deribit, although there's a couple of different products over there. But you take your 1 Bitcoin and you have your cash. Let's think on the call side for right now. Remember, the calls are, you're going to be selling covered calls, right? Covered calls. This is where you own the asset and you're selling other idiots the right to speculate on the price of your Bitcoin. If the price that they speculate on at the expiration of Bitcoin, if Bitcoin is higher than that price, they're going to take your Bitcoin. You're going to get paid for it at that strike price, but they're going to take it. You're going to have a bunch of cash in there. Your Bitcoin will be gone, but you made money. So we have our 1 Bitcoin. We sell 100 contracts, basically that full Bitcoin, at a strike price of $25,000. The premium we collect is $2,200. Now this is a few years ago, but so in your mind, okay, I've got my $10,000 Bitcoin. I now collected $2,200 in December 21st, and I don't remember when we did this. I think it was like the middle of the year, but in December 21st, if the price is at or above $25,000, they're going to take my Bitcoin. Now remember, I'm in this Bitcoin. We are in this Bitcoin for $10,000. So the worst case scenario, well, the absolute worst, the worst case scenario is money-wise. On the right side of the screen, these are your worst case scenarios. So Let me explain based on just that. Don't worry about the 19 or the 2 beneath it. Just based on that, let's say we get to December of 2021. We're in the past now. And the price of Bitcoin is $26,000. They're going to take our Bitcoin. They're going to give us $25,000 because it doesn't matter where the price is. If it's above, we're getting stripped of our Bitcoin. So our Bitcoin is gone. In place of our $10,000 Bitcoin, we now have $27,200. Does that make sense to everyone? We got $27,200. You say, how? Well, because our original $10,000 Bitcoin rose to some number above 25,000, and we also got that premium of $2,200. So we get the 25,000 and we got our premium. The cool thing is you get your premium the moment you sell the contract. You don't have to wait. So what I do is I lever up my Bitcoin with other contracts. So here's how I do it. I had my 100 contracts for my 1 Bitcoin. I sold the $25,000 strike. I got $2,200. I take that $2,200 and guess what? I go and buy more Bitcoin. And I think at this point, it would be after fees or something like that. 19. It should be in a perfect world 22 little mini contracts, right? Because 2,200 on a $10,000 Bitcoin. But I think when we did this, the price of this was like Bitcoin might have been 11 or 12, 13,000, whatever. Anyway, point is, I sell a covered call against my Bitcoin, 100 mini contracts. I get my $2,200 premium. I take the $2,200 and I buy more Bitcoin. Now, if you had time to do this, you would sell a put against that, get put into Bitcoin. But I buy more Bitcoin. So now I have another 0.19 Bitcoin, almost 0.2. I'm going to sell the $50,000 strike at the same expiration for an $1,100 premium. I take the $1,100, I buy more Bitcoin. Do you see basically what I'm doing is I'm taking the premium and I'm reallocating it immediately back. And I think I have some other examples. Let me see if I have some other cool examples. Let me look up options. That was one. I'm trying to see if there's one where the price is a little bit more maybe close to where we are. Let me see. Oh, that one looks pretty good. I can open that one. Let me open this one too. I've got a couple of these. Yeah, okay, cool. I've got a couple different examples. Let me pop in a couple different examples. This might be a good one. We used to do this every single week. That's why there's a lot of these. Let me see if this is that one. Okay, so here's another one, same basic concept. I took my 1 Bitcoin. I sold the $10,000. So in this case, the strike price was $10,000. I sold at the money. Why? Well, because the premium is fat. The premium was almost half a Bitcoin at that time. These were the real numbers. It's crazy. Anyway, I take that $4,800. I buy more Bitcoin. So I think the price was right around 10K, 11. I wish I had included that. That's the one thing I probably should have done. I don't know out of context. I don't know what the price was at that time. I should have put that in the top of these things. Maybe I coded them. Anyway, I'd have to go look. Anyway, so I took my $4,800. I bought more Bitcoin. Well, we know the price of Bitcoin must have been above 10,000 because in order to get $4,800, otherwise would have bought more, percentage of Bitcoin, right? So anyway, so starting at the top, I sold the $10,000 strike. I collected $4,800. I take the $4,800. I turn it back into Bitcoin. I now have 41 mini contracts. I sell the 25K strike price, right, to somebody else. I take the $1,960. I push the $1,960 back in. I now have 0.7 Bitcoin. I take that, I bet, so on and so forth. And what you end up with is 1.49 total Bitcoin. So you're sitting on almost 1.5 Bitcoin. Your average strike prices are between 10 and 25,000. Your premiums, well, you've turned that back into Bitcoin. So technically your premium is zero because you've converted all the premiums back into Bitcoin. However, when expiration comes around, if the price is over $10,000, there's three scenarios. There is all of your Bitcoin is gone because the price is over $25,000, and you end up with a total of $22,250. If the price of Bitcoin is between 10 and 25,000, you would get called out of your $10,000 Bitcoin, but the 0.49 you would keep, right? So you would have 10,000 in cash and you would have half a Bitcoin. And in a scenario like that, you still end up ahead because it's over $10,000, which is over where you started. So you're sitting on half a Bitcoin in the $10,000 to $25,000 range plus your $10,000. So that is better than your original $10,000. Is it not? It is. It's at least $5,001 better. So you still have a 50% return on your investment. Or you have the first scenario where Bitcoin is at or below 10,000 and you just keep 1.49 Bitcoin. I know this is kind of, I'm just throwing this at you guys kind of fast, but do you start to kind of see where this is? Let me see. With Bitcoin ETF, the prices are more stable. Does that make options less profitable? I don't think the price of Bitcoin is more stable. I'm not sure if you guys saw what I saw over the last couple of days, but to me, just one dude over the last 7 days, that let's switch that. Let me stop the screen share and let's show this other one. To me, that doesn't look that doesn't look so stable to me. When you see moves like that up and down 10, 12%, that's where you get volatility equals premium and time equals premium. So volatility equals premium, time equals premium. Know what I'm saying? Yeah, no. Doing weeklies is amazing. So the strategy I just showed you was a longer term strategy. You can sell options at the weekly level. You can sell options. I mean, depending on Deribit has like dailies. You can do dailies. You really want to be a DGen. There is a lot of money to be made selling cash secured puts and covered calls. So the same process works on the other side. So that's why the rule of thumb or the saying is call your way out, put your way in, or put your way in, call your way out. You say, why? Well, let's say you started with a pile of cash. I got my 20,000 bucks. Let's just use the $10,000 example. I got 20,000 bucks. Okay. 20,000 bucks. I'm going to sell, let's pretend Bitcoin's 10K. I'm going to sell puts I'm going to sell some at 9 and I'm going to sell some at 8. If I can get a 10% and a 20% discount on the price of Bitcoin, I'll take it. Now imagine in our $10,000 Bitcoin environment, Bitcoin moves around, but how often is it going down into the 8s or up to 12 or whatever? I mean, the more that it's doing that, the more volatility, the more premium will be baked in there. Because remember, the more time you have, premium that's on the options contract. The more volatile the asset, that equals premium. Because that's going to make it more likely that all of these scenarios could hit, right? So there's a lot of volatility premium and there's a lot of time premium. As time dwindles, so too does the volatility premium. That's why premiums on options contracts dwindle to the point where you have the expiration date and all that's left is what's in the money and what's out of the money. If it's out of the money, it expires worthless. The few contracts that are in the money, there's some value there, which is about 10% of the total market. 90% expire worthless. So again, you want to be an option seller, because if you own the underlying asset or you own the cash, it's just a constant money generator. So you take your cash, I sell the 9,000, I sell the 8,000. Bitcoin drops down to 8,500. Think about that for a second. So Bitcoin goes down to 8,500. I took my 20K and I sold my 200 little mini contracts. I sold 100 at 9,000 and 100 at 8,000. So I collected those premiums. Those are cash. That's in my back pocket. So let's say I put $2,000 away. I got my $2,000. In that scenario, the $8,500 scenario, I'm going to keep my cash that I sold puts on at 8,000 because it didn't go below 8,000, so I'm not getting put in. But I am going to get put into Bitcoin at 9,000 because it did drop below 9,000. So my $9,000 put is going to be in the money, meaning I'm going to get put into Bitcoin. So now I have a $9,000 Bitcoin and then the rest in cash. So I have my $10,000 still, and I have my $2,000 in premium. So now I'm sitting with one Bitcoin and $12,000 in cash. I'm still better than I was. Wash, rinse, repeat. And what you can do, depending on your desire to stay close to the market, that's where in time you sell these contracts. So for instance, if I want to do this once, collect a fat ass amount of premium, leverage up my Bitcoin all the way to the moon, leverage up my cash all the way to the moon, but be done with it for 6 or 8 months, you'll sell contracts 6 or 8 months in the future, maybe a leaps, maybe sell way into the future, a year into the future. You could sell contracts that expire in December of 2025 or the first quarter 2026, right? So, but remember, a lot can happen in Bitcoin in that much time. So depending on everybody else's outlook, you would sell options way out. What I chose to do is I had a mixture. I would take my Bitcoin and I would divide it into 3 buckets. A long-term bucket, a short to medium-term bucket, and a speculative bucket. And so what I would do is I would sell options contracts at different time intervals and different strike prices that expressed those different ideas about the market. And that's all based on you. That's like, those are strategies you come up with. But this is what I did consistently from 2019, 2020, 2021, 2022, and just weekly and monthly and quarterly income, just over and over and over. It was great. And then Ledger X kind of went out of business because I knew it was a problem when they got bought by FTX. I knew that if they were dumb enough to make that deal, that was probably going to be the end of it. And so at that point, I just sold a bunch of long-term contracts, hung out. I made my clients a crap ton of money. And I did pretty good myself, not going to lie. So, yeah, that was the strategy. And again, there's more to it, but that's the kind of the broad strokes of it. And so when you have these markets with assets that are extremely volatile, a lot of good money. How far out of the covered? Let's see. How far out of covered call would you do? Do you mean, Frank? Do you mean time or strike price? Do you mean how far out of the money would I go with strikes that I would sell? I don't want to be called out. So I'm trying to kind of maximize my premium and minimize the reality of getting called out. I have a buddy who runs a fund in Dallas. Actually, his fund got bought by Chase, but he still manages it. His entire career was selling puts against assets that he liked. He's like, if I get put into it, I don't care. His whole career, all of his money, I mean, his entire professional career was selling puts. He couldn't pick anything. He was terrible. He's like, I don't know the future. I don't know what's going to happen next. But he just grinded out a huge income, cash, secured puts. He would sell puts way underneath assets that he liked. And he's like, look, if this thing goes all the way down and I get put into it, great. I love this stock. But if I just sell puts forever, what difference does it make? He made a lot of money for his clients. It was slow, tedious, consistent, and he got rich. So there you go. Let's see. You sold Bitcoin less than 105. Are you saying you sold those? Oh, strikes. So I would typically, like, if we're talking right now terms where we're looking at and again, I don't know what the options chains against the ETFs look like. I would have to start doing some math in my head for a few weeks to figure out where those are, because again, it's two moving parts, not one moving part. I don't really like that. But if I'm at 100 right now, I'm probably selling 120. If it was a weekly, I'm selling the 110s. I would sell between 108 and 110. And if it was and again, I'm talking about the Bitcoin price. And if it was monthlies or quarterlies, I'm selling no less than like the 150. I want to be way over that because, Bitcoin can run fast. I mean, look what it did last year. Right? There was parts of the year where it was in the 30K range, and all of a sudden we're 3x of that. So in an asset that can move that fast, I would want to be selling 25 to 35% out of the money, because I don't want to get called out. I'd rather collect a smaller premium and convert it, because I used it. That was my Bitcoin mining. That's how I mine Bitcoin, is by selling covered calls and cash secured puts, putting the profit every few weeks back into Bitcoin. And if I was selling my bucket, my far off speculative bucket, and you also have a cash generation bucket where you basically sell at the money, collect the biggest premium you can, and just wash, rinse, and repeat. So that's put your way in, call your way out. So if we're at basically 99,000, I'm selling the 95,000 or the $92,000 puts, expecting that one every 5 or 6 or 7 weeks I'm going to be put in. And then immediately, the second I'm put in, I'm selling calls, because I want to be close to where the action is. I'm selling calls, 5 to 7% out of the money, and just imagine if you get, if you're getting in there over and over and over, and you're not being stupid, 9 out of 10 times these options are expiring worthless, meaning 9 out of 10 times you're collecting the premium for free. And then the one time you get put in, or the one time you get called out, you just immediately sell the put against it or the call against it, depending on which way you went. And it's just a constant. CMAS, but I don't know what that is. That sounds cool. I don't know what that is. Anyway, that's kind of all I have to say on that. Well, it's not actually all I have to say on that. But those of you that have ETFs, you guys should be exploring this. You're going to have to spend some time really grappling with what does the price of Bitcoin do to determine the movement in the price of your asset. Because remember, it's two groups of investors, not one. If you're selling calls against Bitcoin, options against actual Bitcoin, it's just one group of price movements. You now have two. You have the ETF price with a bunch of traders, and you have the underlying asset price, and they're not pegged. They're correlated, and that's the difference. Oh, you're at Deribit. Yeah, I don't know. They won't let me trade on Deribit because I'm in the US, and we tried to set up a foreign account. I have a buddy in Spain, and they said, okay, but if you're trading on behalf of someone else, we'll take all your money. I was like, I don't think I'm going to do that. Because I just have a big old pile of dormant Bitcoin and dormant Ethereum that's not doing anything. And I could be earning a lot of revenue on those bad boys. So yeah. Anyway, that's our little, we descended into options. Yeah, we all hope Howard gets healthy. Okay, real quick, let me just spend un momentito. Let's talk just for a second about the 5 T's. I think sometimes we forget these things. Let me find the 5 T's. Where are we? Come here, fellas. I have all these cool things. Where are you? Okay. Let's spend just a little bit of time building our brains.
Hello. You're late.
You're bad at math, but I'm giving you an A+ in confidence.
Just doing what I gotta do.
Extra credit.
Okay. Quickly, let's talk about team, technology, timing, tokenomics, and token necessity, or as we like to say, why token. Okay. So first, we look at the team. I usually go team, timing, technology, right? Team, timing, technology. So team, assess the team's reliability, their expertise, their integrity. The integrity part, that knocks out most of them right there, doesn't it? Consider their track record, what they've done at businesses before they arrived at this particular business, their trustworthiness, whether they possess the necessary business and technical skills to execute the project effectively, ASI. A strong, transparent team with a history of success is crucial for a project's credibility. But the thing is, even if they have these things, doesn't necessarily mean they're going to nail it. And that's the thing you have to be careful about. Just because, even if it crosses even if it checks all the right boxes, it doesn't mean it's going to make it. It just gives you a score of 1 to 5. Amazing team. Let's look at timing. Consider a project's relevance within the current technological landscape. Analyze whether the project's concept is timely. Is it ahead of its time, or is it lagging behind technological advancements that have come around since they launched, like XRP in 2017 made a lot of sense. So did XLM. Neither of them do now. They don't do anything specifically interesting. They're actually pretty weak technologically. So timing can significantly influence a project's adoption and success. Obviously. Look at the technology. Evaluate the project's technological foundation and innovation. Determine if the software and their planned upgrades, look at their roadmap. So look at if their upgrades are logical and feasible, right? Like right now, Hypercycle is reducing the tech heavy part, the education heavy part of running nodes. They're reducing it. They're making things much simpler. There's a lot of adjustments coming that will make your life a lot easier if you own node factories, right? So they are simplifying in a logical way the use of the ecosystem. So look, when you're looking at these different projects, assess whether they are introducing a novel solution or are they replicating somebody else's idea. And if it addresses problems in an elegant and understandable way, right? If it's incomprehensible babble, don't invest in it. If you can't understand it, then they can't understand it. Because if something is understandable, it would have been explained to you in an understandable way. And there's a good chance if it's a bunch of babble, they don't understand it either. So be careful of those things. If you don't understand it, don't invest in it. Tokenomics. Understand the project's economic model, including the token distributions, the different allocations, their release schedules, who owns what. Look at how tokens are distributed among the founders, the investors, the community. Normally, any distribution of tokens above 15% to the founders is sketchy. Really, really sketchy. So just be careful. They better have a dang good reason why they're over 15% of the entire monetary supply to put in their pockets. But they came up with the idea, so they deserve 15%. All right. Look at what the investors own. Look at their lockups. Look at if they had any sweetheart deals. Try to figure, look at that stuff. Look at the community. Assess whether their working model promotes long-term value and sustainability, or is it just a quick hit? Right? And then finally, why token? Question the fundamental need for the token. Determine if the project's goals could be achieved using other tokens, existing protocols. Ensure that the creation of a new token adds genuine value and utility rather than ASI, focusing or complicating the ecosystem unnecessarily. Common sense, right? And what are we doing? We're looking to score each one of these between 1 and 5 points. We take the cumulative score, and if it's 18 or better, then it is something we would consider for investment. But there's one more thing. It needs the 5 pillars, or at least some of them, for project success, and that is use, utility, wide-scale adoption, hoarding effect, and what would dummies do? Will dummies buy it? Right? So, use. Will the project have a clear use case that attracts active users? Use case, not hoard. Hoarding is different. Is there a use case? Meme coins? No. Utility. It should offer tangible benefits, improving existing solutions or creating some new opportunities, solving some problem or some friction in society. It must have utility. Adoption, right? Wide-scale adoption. The project should demonstrate the potential for widespread acceptance and integration by individuals and institutions. Hoarding effect. Are other people going to see what you see and hoard the tokens? Hopefully. And then, what would dummies do? What would a bunch of dummies that don't know anything about this space, know less about finance, and know even less about investing, what would they do? Because there's a lot. If you haven't noticed this, there's more than 751,000 dummies. It's just those are all the dummies that are bankrupt after the last 3 days. That at least they're going to have to go drive Uber and Lyft or work 2 more shifts in the bar to get a little bit of extra cash to go punt it back into the markets. They'll be here. It's going to be a couple weeks. They got to wait for that paycheck. So what would dummies do? Well, you get enough dummies together. Look, GameStop, Ford, Hertz, AMC, fail. All of them fails. And yet people throw money. Why? Because the guy with a headband drinks a beer. Come on, man. But dummies do dummy stuff, and there's a lot of dummies out there. So don't dismiss the dummy dollar. Don't dismiss the dummy dollar. The 4 Ds, is that a new thing? Don't dismiss the dummy dollar. All right. Okay, I think we nailed it. So we'll see you tomorrow. Today is the last day. Today is the last day for in GMRT. That will end tonight at midnight. The date they are launching on the 13th. So that is absolutely happening on the 13th. 13th, they launch. You will be able to swap the tokens 1 for 1. Like, you get them that day. Whenever they give us the tokens, we give you the tokens. Those are tradable instantly. There's no lockups, no nothing. Yeah. Okay. There will also be a pool that will go into effect because this is going to be a launch on the base network, as far as I understand it. So there will be pools, which is great because the fees will be dust. But there will be pools that go into effect sometime that day. I think they're going to be paying 25%. I think. Yeah. So anyway, keep that in mind. Okay. Stay in school. Don't do drugs. Don't do anything my poor insolvent drunk, starting on meth grandmother wouldn't do, which is very little. I don't know what the temperature is where Brandon is, but since it's down around 60 degrees here, I'm guessing it's going to be cold AF where he is at. So wear a jacket, buddy.
purified, wandering mind, the seams have come undone. You've been telling lies to these eyes as if they'd never seen the sun. Now you've let your guard down and your heart is exposed. Now you've let your guard down, but how could you have known that I'm the big fish round here? You're a small fish. I could make you disappear. You should know this. I'm the big fish round here. You're a small fish.